Hi, this is Alan House. I'm a senior analyst here at Value Line. I'm joined today by two other senior analysts, Sharif Abdu and Charles Moran. We here at Value Line hope you and your family are staying safe and dealing with this difficult time as best as possible. Today, we're going to provide an update on the coronavirus and its ongoing impact on the economy and stock market. We will also discuss the actions Value Line is taking to help our subscribers navigate this difficult time. We will then recommend one stock to buy right now, and finally, answer any questions you may have. Please note that this presentation will be available on our website, www.valueline.com, and our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are here at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is a Value Line investment survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research team, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including the 1,700 that are included in this service. Value Line does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or different tiers of subscriptions, that information can be found at valueline.com or you can call 1-800-VALUE-LINE. Now let's discuss the coronavirus, the economy, and the stock market. This content was prepared by Harvey Katz, Value Line's chief economist. Overall, the economy continues to show signs of revival, including in manufacturing and housing. The employment picture, however, remains a stubborn challenge, with jobless filings still close to 1 million week after week. The challenge remains the persistence of COVID-19, although thankfully numbers are trending down at this point. Travel and service industries continue to feel the impact heavily. Partway into the new administration's first 100 days, it appears Washington is well underway to enacting additional and substantial stimulus. As to the outlook for equities, recent action has pushed the market to new highs, although this week has seen notable pullbacks in the roaring technology sector. Overall, there remains little room for missteps on the economic, earnings, monetary, or fiscal fronts. It is just that a good deal might have to go right to keep PEs where they are. In conclusion, we think the bull market is sustainable, but likely to face challenges in the coming months, particularly if yields on fixed income securities, for example, Treasury notes, rise much further. I want to touch base on one sentence of Harvey's view, and I quote, "This should not suggest that stocks cannot go higher. Clearly they can, and for a time might well do so, as it always is hard to fight the tape." That has long been Value Line's perspective, that equity should be a core component of a well-rounded, well-diversified portfolio. In good economic times or less favorable times, in bull markets or bear markets, equity should be a core holding investment portfolios of all stripes. To touch on some of other portions of Harvey's commentary, and I'm paraphrasing this, the economy, both in the U.S. and abroad, is still in a recovering state, and it might well take a while before we see a meaningful recovery, while there also may be some hiccups along the way. On that note, Value Line is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, Value Line provides a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desks, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that's www.valueline.com. I will now show you how to access it. Once signed in, head to the dashboard where Sharif is already located. This is the main landing page for subscribers. Under the quick links, click on Supplementary Reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. We are also aggressively adjusting our financial strength grades. Individual companies are dealing with sharply reduced demand for their offerings and supply chain problems, among other issues. Consequently, corporations have been implementing cash-saving initiatives such as headcount cuts, the slashing of advertising budgets, and reducing or eliminating their dividends. Taking on additional debt has also been popular as a means to build cash in anticipation of a difficult times ahead. Due to rapidly deteriorating balance sheet, Value Line has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage. These changes are posted each week in our SNO, which is Selection Opinion newsletter. For those of you who don't know, financial strength, along with price stability, another proprietary Value Line measure, are the two metrics that are used to calculate a stock safety rank, a key measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information in regard to our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds. Certainly, particular industries and sectors will recover more quickly than others during and after this pandemic runs its course. Okay, now we're going to get to the screener, the one stock to buy right now. For this, let's go to the screener. Value Line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscriptions. If this interests you, please call 1-800-VALUE-LINE. Please call 1-800-VALUE-LINE. Okay, and here's the screening criteria steps. Today we'll start the screening process by looking at growth rates, particularly over the longer term. Then we'll add some shorter term metrics as well as balance sheet considerations. Okay, the first thing we're going to look at, which Sharif is on, is the 5-year earnings per share growth rate of at least 20%. Okay, for those of you who are unfamiliar, Value Line provides estimates for both the short term, as in this year and next, as well as 3 to 5 year investment horizons. For this screen, we're focusing on companies that had a 5-year earnings per share growth in excess of 20%. As a reminder, this is based on historical earnings. Now we are going to run this screen. There are roughly 5,700 stocks in our database, and we're already down to 387 stocks. We've substantially narrowed down the list of candidates. We want to stay with the same theme of longer-term performance. We're going to add another filter, this time looking at sales. We also want to look at a company's top-line growth over the past 5 years. This is another important metric to look at because sometimes a company's earnings growth may be due to cost-cutting or other measures. Let's now look for companies with at least 20% sales growth over the past 5 years. So now we've narrowed our list down to just 62 stocks. As you can see on the screen that Sharif has up. So we went from 387 stocks down to 62 stocks just by running one more screen. So we're narrowing it down with each screen with each input we put into the screen. So we have looked at some historical performance indicators. Now we're going to take a look at some projections for future share price results. For this screen, we're going to focus on the 18 months ahead. So now we're going to look at stocks that have 18-month total return potential of at least 20%. And once again, this is a forward-looking measure. So after doing this screen for 18 months ahead of 20% returns or more, we are down to 11 stocks. It should be 11 stocks. Yes, we're down to 11 stocks. So we keep whittling it down, but we still have a few too many stocks to make our choice. So we want to put one more metric in there. So now let's go with an additional level of security. Due to the current economic environment, balance sheets have greatly weakened. As a result, loads of companies are reducing headcount, taking on more debt, and reducing or outright eliminating dividends. I'm going to now talk about the financial strength. These grades range from C to A++ in steps or increments. Today, we're only going to focus on stocks that carry financial strength of B++ or better. We want strong companies. And Sharif's going to run that screen. And now we are down to should be 8 stocks. Yes, 8 stocks. So now we whittled the list down to 8. Okay, so you can certainly make an argument for any of our remaining stocks. And investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now. And after consulting with a number of my senior analysts, we prefer and recommend Centene, ticker symbol CNC. Before I click on Centene, please note that the screens can be saved and revisited by utilizing the Create Save Screen button on the top, as Sharif is showing you now. Okay, and so you can name it whatever you want, Save Screen or what have you, or Centene Screen. Okay, now we're going to shift gears and we're going to click on Centene and get some additional information from Value Line's digital report. Okay, thank you, Sharif. Centene provides services to government-sponsored healthcare programs targeting underinsured or uninsured individuals. It offers health plan coverage through government-subsidized programs such as Medicaid, Medicare, and state-sponsored programs. Okay? In the banner section of the report, you will notice that the stock is now trading at 50. It's a little small. Sure, if you can make that a little bigger. So I could, there we go. Yeah, the stock is currently trading at 58.76. And our 3 to 5 year target price range is 85 to 130. With that said, we think the stock has some more room to run, both in the intermediate and long term. Okay, now let's take a look at our last full-page report, which was published late last year. As you can see in the statistical array, or the center of the report that includes the financial data, we expect revenues and share earnings for Centene to advance at a solid clip in 2021, thanks to new programs and the expansion of existing ones. We also look for the company to continue to receive a boost from last year's acquisition of WellCare health plans and membership growth in the Medicaid and health insurance marketplace segments. Metrics are solid. The safety rank is 3, the timeliness rank is 2, and the financial strength is B++. It also offers strong price appreciation potential, both in the near and long term. At the midpoint, our 18-month target price range is 45% appreciation potential, and for the 3 to 5 years ahead, the midpoint's about 80%. All told, we think that Centene's position is quite strong, and the stock can form one of the building blocks of a successful portfolio. It is today's one stock to buy right now. We will now tackle your questions. Please note, we typically can't answer complex questions about specific stocks on the spot. For this, we recommend a review of our latest reports. The first few were submitted prior to this presentation. Now I'll hand it off to Charles and Sharif. Thank you.
Just read a few of your questions. I received one from a Neil Rubenstein asking about saving specific filters for screening, and I don't know if we can go back to the prior pages to see the screening, but you can, in fact, save filters that you've run in the past and save them. There's a drop-down menu in the screen. I don't know if we can get that up, but you can save. You know, I run a handful of them, so yes, that is definitely possible to do to make your own set of independent screens. Sharif?
Okay, thanks, Charlie. Ned Roberts had, I think, a very relevant question considering the current state of the market. He asked, to get value, I limit my purchases to a PE with less than 16%, or excuse me, with a PE of less than 16 times. It appears that average PEs are getting higher. Should I raise my purchase PE limit to something like 22 in view of growth? That's, you know, growth seems to be the new normal for most of the market. So our view at Value Line is we don't have a one-size-fits-all outlook for, you know, the market, you know, the price performance ratios, or what your risk reward profile is. That's very personal. That's a very individual thing. Generally speaking, Value Line tends to peg the market PE at about 18. Okay, and I see that Ned has pegged his sort of threshold is about 16. I don't want to give you direct financial advice because obviously I can't do that. I don't know what your what Ned's unique investment portfolio looks like, what his unique, you know, individual situation looks like. But I would say if you are going to raise your sort of threshold, that's going to be a very individual thing. That's going to be a very personal thing. That has to be based on what you're comfortable doing. I mean, the market obviously is a little bit, let's just say, frothy. So you may have to nudge what your personal threshold is right now, up from, say, 16 to maybe a little bit higher. Again, I don't want to give you any direct, investment advice, but, considering what the state of the market is right now, you might have to be a little bit more lenient or have a little bit more, you may have to, like I said, nudge what your threshold is right now. Charlie?
Sure. We just got another relevant question from Sherry Holdeman asking about why investors would purchase or buy stocks with very high PE ratios. And again, this is a subjective view, but very high PE ratios don't necessarily mean a stock is necessarily expensive. Typically, they're associated with growth stocks. And if one believes that the growth rate of the company in the future is going to be very high and the future cash flows associated with that business are going to be not only high and sustainable but consistent, they will be willing to pay everything else equal, all other factors equal, they will be willing to pay a higher multiple for that stock. And that's why one would choose to buy a higher PE ratio than just the nominal PE ratio than a lower PE ratio. But that is a function of many things, the investment climate and the investment alternatives. As you see, the bond market backing up, that raises interest rates, it raises the discount rate. So there are many choices, obviously, as an investor, between equities and bonds, alternatives, precious metals. But when you're thinking about paying a price for a stock, you have to consider the growth rate in the future, the future cash flows that the business will generate when paying a certain multiple. Sharif?
Okay, thanks, Charlie. I see an interesting question here. I see a question about how do I find stocks using the screener that's a high dividend, not a high dividend yield. This is Neil Rubenstein. He's asking specifically, how do I find high dividend stocks in the stock screener? So Neil is not asking about high dividend yield, but a high dollar amount for the dividend. As far as I know, there is no way to do that in the screener, because we are looking specifically at ratios. We're looking specifically at percentages. Let's say that a stock has a very high absolute number. Let's say it's $10 per share that the company pays as a dividend each year. Well, let's say the stock is selling for, $500 a share. Relatively speaking, that's, it's not an outrageous dividend yield. What we're looking at is specifically, like I said, the ratios. We're looking at the yield. We're looking at the percentage of the company's earnings that are being returned to shareholders in the form of dividends. Now, if you're looking specifically at dividends, I'm going to go off on a little bit of a tangent here. If you're looking specifically at dividends, don't just look at the yield, although, obviously yield is, the headline number if you're looking at trying to generate current income. You would also look at things like the percentage of the dividend relative to, let me show you on the report here. So if you're looking at the Value Line report, this is Centene, by the way. So if you're looking at, this company doesn't pay a dividend, but work with me here. Let's just say that the company actually paid a dividend. So here you would see the absolute, the number in absolute dollar terms. Let's say it was paying a dividend of $1 per share every year. The number we would also look at is this number down here, which is the all dividends to net profit. It gives you, in broad strokes, an idea of the company's dividend coverage. Okay, that's the payout coverage ratio. So we want to see how well is the company's payout covered by the company's earnings. Obviously, a lower percentage here would be better. So the dividend representing a smaller percentage of the company's earnings is better than the dividend representing 100% of the company's earnings. That means that their coverage, their ability to sustain and expand that dividend in the future would be less. It would be weakened. So we want to look at things something like, the ratio of the dividend to the company's net profit. And typically we want a number that's lower here. So we would want 10% would be better than 20%. Okay, I'm just speaking in very broad terms. Other numbers you would want to look at if you are concerned with generating current income, if you're concerned with the dividend and the dividend yield. You would also look at, I would strongly encourage you to look at the capital structure. Okay, I'm highlighting the capital structure right now. And the thing you would look at is not just the absolute number of total debt or long-term debt. What you really want to look at is this number right here. Okay, I hope that's showing up clearly on the page, on the screen. You want to look at this number is telling you that is the ratio of long-term debt to the company's total capital. Okay, and again, you want this number to be lower is better. So you want debt to comprise a lower proportion of the company's total capital. That means that not only does the company, not only is it not heavily leveraged, it also means that the company has the ability to sustain its interest payments, and it has borrowing headroom for the future. So that means that the company can have, if an investment opportunity pops up, they will have the borrowing headroom and the liquidity to maintain its current operations, to continue to invest in R&D, and to continue to, cover its interest payments and increase the payout in the future. Also, with regards to the dividend, in general, we want to look at companies, we want to look at their safety rating, okay? We want to look at the company's financial strength rating, okay, and that's down here. Now, that doesn't mean that you preclude a company that has a lower financial strength rating. Let's say in absolute terms, you have a company like Apple that has a financial strength rating of A++, and then you have a company XYZ that has a financial strength rating of B, okay? Just because it has a weaker financial strength rating does not mean that you are going to eliminate that from your consideration as a dividend, as a stock to generate current income through the dividend. It just means it's something that you have to take into account. I hope that answered Mr. Rubenstein's question. Charlie, anything else popping out at you?
No, I'm just going to take one more because it's relevant to the page overview that you gave, and it was Mark Palamas that had spoken about how to get a range of the historical price-earnings ratio, and you touched on much of the page, but if you could scroll up, we can see not the ranges for each of the years, but you can see the average PE ratio and the average relative PE ratio in the prior years. So in the case of Centene, right now it is trading, as you can see above, at the top of the page, 14.2 times the current earnings estimates, and that is a 6-month forward and a 6-month prior estimate. And then you have, going back from 2019 to 2004, the average annual P ratio, starting there where the cursor is, at 12.3 in the prior year, and going back, you can see that it's traded between 12 and 23 times earnings, and that can give you not a range for each individual year, but can give you a sense of the difference in valuation through its history. The NMF is going to be used when the EPS for that year, as in in 2012, the NMF occurs because the earnings was 9 cents that year. So if the multiple is over 50 times, typically we will have the NMF figure. And that's it. That's all I saw. Sharif?
Thanks, Charlie. I think that wraps it up for today. I want to thank everybody that participated in our webinar today. Again, if you have any questions, you can call 1-800-VALUE-LINE. You can also visit valueline.com, spelled exactly as it sounds, VALUELINE.com. This webinar will be posted on our YouTube page within the next, I believe, 48 hours. And all past webinars are there as well. And again, thank you for participating with us today. And at this stage, I'm going to turn it over to Andrew. Thank you, Andrew.